slowdown in population growth, which we've been seeing really for decades in both developed and emerging markets, is a reason to expect lower real interest rates here, right? So the more older people that you have essentially saving, trying to put money aside for the future, relative to a smaller number of younger people who are likely to be in the borrowing phase of their life, where they're buying houses, buying cars, taking money out on their credit cards, paying for education, things like that. If that balance shifts, then you should expect lower real interest rates in the long run. So I do think that slowdown in population growth has been an important driver of the decline in real interest rates that we've seen over the last 40 years, really.
And do you think the slowdown is a major shift, is structural, or can it change?
I think it's unlikely to change, right? We've seen that over the course of the history of economic development, really, as countries get richer and start to develop, their fertility rates tend to fall. That's been happening in developed countries like Japan and Europe and the US for quite a while. China is actually fairly far down that path already. And then if anything, we might expect that emerging markets where population growth is still higher are likely to see that growth slow if they continue to develop over time. So, I do think the slowdown in population growth is likely to at least persist and likely continue. And that will probably be a continuing drag on real interest rates going forward for decades.
Jesse, it's Nancy here, and thanks for bringing us this note. And it does, you also drew some interesting correlations between what's happening with population, low real rates, and PE ratios. And this is significant because it comes at a time when many are looking at historically high PE ratios, wondering if this is a signal of an asset bubble in certain places. Just walk us through what that relationship is and what conclusions you can draw from it.
Well, sure. So we're saying here that slow population growth essentially means that there's excess capital in the world, right? There's lots of money searching for yield, right? And all that money that people are trying to save it's going to push down interest rates. It's going to push down returns on capital. And so, sure, that obviously means that you should expect a lower rate on your savings account or on a bond yield, right? But we also think that that demand should spill over into lower expected returns on equities or real estate. And so if you think, well, what's the equivalent of a bond yield for the equity market? It would be something like the earnings to price ratio, right? So if we expect interest rates to fall, we should expect lower earnings to price ratios on average going forward. And so if you have a lower E over P ratio, that means you have a higher P over E ratio. So, I do think we should expect higher PE ratios to be the new normal in this world of lower population growth.